Thank you, Giovanni. Yeah, so I should be telling you about some of this kind of secretive world of what goes on in high-frequency trading, and particularly some of the kind of new hot technologies we use there. Before I start, though, can we get an idea of how many of you actually work in investment banks or are familiar with trading systems at the moment? Okay, so we've got quite a few there. How many of you are quant programmers? Okay, so we've got a few. Okay. So what I'm going to do is give an introduction of what a trading system looks like. Then I'm going to be talking about some of the new technology, some of the styles of programming which are relevant in that space. So I think we've got a fair mix. So I probably need to spend time on both of those. So first of all, something about me. I like to describe myself as a platform architect. So I tend to work at all layers of the system, so both software and hardware, and work very closely in terms of putting all those together as an overall platform. I actually started my career as a hardware engineer, actually designing systems. So I actually designed and built my own computers initially, so right from the chip level, designing the circuit board, laying out circuit boards, soldering chips on, and built my own computers that way in the early days. And really, kind of, it was only as I started to program them, and the programming took longer and longer. It took me longer to program a computer than it did to design and build the hardware, and that eventually kind of became my career. Was focusing very much on that overall system. So you can see there, I've been through a whole range of languages. On the banking side, I've worked for many of the major banks. So I'm at Barclays now, and most of you will know Barclays kind of acquired Lehman's, at least the US part of Lehman's, following the collapse there, and really got a big injection into the whole investment bank side. It is one of the major investment banks. We handle a huge amount of business. Probably something like 70% of the flow through the New York Stock Exchange goes through Barclays. We're major market maker on there, so huge amount of business we do there. I should be talking about the trading systems, but I'm actually a technologist rather than a banker, so I very much focus on that technology layer. And really, that's kind of what I like doing is discovering new technologies, seeing how we can leverage them in these environments. And this environment is where we get to play with the latest technologies all the time. Let me kind of mention some of the things there. So I give you a quick intro on trading systems. Then some of these specialist areas which you need to have knowledge on if you want to work in this space. So low latency, and aside from that is low jitter. Both have big effects. What kind of expertise you need on the C++ side, on the Java side, and some of the technologies we're making a lot of use of here. So I should be diving into those, RDMA, GPUs, and FPGAs. And of course, I couldn't come here to a conference like this and not mention functional languages. So I'll mention a little bit on that. For some legal stuff, and this is really more to emphasize. Okay, question there.
What is RDMA?
We get there. So there's some slides on RDMA, so to explain what that is. So this is more to, this whole area is extremely secretive. That in trading systems, particularly high frequency trading, there are no second prizes. You've either got the fastest system, or you may as well not bother. And really, as a result of that, you'll find it's a very secretive area. If you want to work in an environment where you're pushing stuff out to GitHub and talking about your new algos at conferences, high-frequency trading is not the place. It's you develop something, the bank will want to keep it to themselves. We take technologies from elsewhere, but the smart stuff which gets done is very much kept inside the organisations. It doesn't leak out, so you won't hear a lot often about what goes on inside these organisations. So in order for me to present here, I have to talk in general terms. I'm not allowed to actually give any specifics of what we may or may not be doing within the Barclays Bank. Okay, just a few quick intro stuff, and mainly so you get to know the language. So for investment banking, we very much talk about front office, which is where the traders sit. So multiple screens. I've got traders with up to 16 screens they're looking at a time. That used to be very noisy. It's not so much now. It's a bit more controlled now than it used to be. You've got the middle office where the people are looking much more at strategies, where there's a lot more deeper thinking. And then finally, you've got the back office, which is really doing the end of day markup. It's doing the general ledger. So things tend to be very dynamic, happening very rapidly at the front office. Things get slower as you move back. It's all about buying and selling, and really we talk about the venue that can be the places like a London Stock Exchange. It's NASDAQ. It's lots of different venues around the world. And really, it's all about buying and selling, and there's a spread then between the price people are wanting to sell at and the price people are wanting to buy at, and it's really kind of that spread is fairly key. I'll come on to that in a minute. So in fact, this probably shows it better here with the trading book. So at any point in time, there are people trying to sell something. So here you've got somebody who's willing to buy at 397, but at the moment there's only people willing to sell at 401. And really, what's going on in the venue is it's trying to match buyers and sellers, but of course there's always this spread in between. And we talk about so these are people willing to buy stuff here. People want to buy at a lower price than people want to sell. And we talk about all these orders sitting there as being the full book. And there's all of these sitting is what we talk about as the liquidity of the market. There's no point you going to sell something somewhere if there's nobody there to buy. So always what we're looking at is how much liquidity is in the market, how many orders are likely to be there. So the venue then is trying to match these. Often what you find are that there's strategies like market making where you can sit slightly outside. So you can be sitting here at 396, waiting to see some momentum come and move this along here. And you can quickly then match against that. Then as the momentum carries it further through, you can then sell and make a few points on that trade. And that's often what happens in these kind of markets, that people are sitting there purely to provide liquidity. Trying to monitor this is hugely complex, and the data rates at which orders come in and those get matched have been going up exponentially. If we look at something like Opera, we've already hit, I think it was over 5 million messages a second. Actually, trying to capture all those and make sense of them is extremely difficult. And it's really at those bursts, it's a very bursty environment where you either make a lot of money or lose a lot of money. And certainly for the systems we build, trying to capture that data with current technology is actually one of our biggest challenges. So I come on to some of the things we do around that. Computers today just aren't fast enough. That's the basic problem, and they're not getting any faster. So we're having to adopt more and more exotic techniques to actually keep up. So two main types of trading. Obviously, we want to make a profit. There's the theory-based investing where you understand who you're investing in. I'll come on to to that as well. That's much more kind of longer term. What we talk about high frequency trading is much more speculative. It's statistical, it's trend driven, but it's very short term. You may actually only hold a stock for microseconds. So I mentioned liquidity, so it's the most precious thing a venue has. And venues will try to increase their liquidity by offering lower fees, or they pay market makers to offer liquidity in that market. So it's all about attracting that. This kind of shows the trade, the flow of a trade, which goes through. So first of all, we have to understand the pricing. We have to understand the risk around that. Position keeping is your blotter, your portfolio. So I've got a set of investments. What are they worth? What does that look like at the moment? Where do I need to buy stuff? Where do I need to sell stuff? That's really what that's about. You've got the actual trading itself, and you're validating that the trade took place. You've got the back-end routing of that as that goes through to the back office. Enrichment is saving that kind of information around that trade for further analysis. You've got the confirmation that the trade took place. Settlement is now paying the other party. That's got to go through settlement. And then finally, it's got to flow through through the general ledger. So a lot of systems in place. We have hugely complex IT systems in the banks to actually put all this together. Probably the most complex IT systems I've come across anywhere. It's staggering the complexity of the systems connecting all these together. Something about the trading strategies. So the very simple ones are just ARB, or arbitration. And that's really where you're exploiting the fact that maybe the same stock is on sale at two different places. And therefore, if you can see that it's on sale there at a different price, you can buy it at one and sell it at the other. Very simple strategy, very latency dependent. You've got to do that quicker than the other guys. More sophisticated momentum. So that's looking at, okay, the whole market's moving up. Let's hope that's going to continue. We buy something now so we can sell it at a higher price moments later. That's a momentum. Alpha or pairs is really, for example, there I may make a judgment that maybe, for example, BP and Shell should have a similar kind of momentum. If one goes down, maybe I could expect the other one to. And that's really okay. I've seen BP move. I'm going to place a bet that Shell's also going to move in that same direction. So that's really what's that about. Composites. There's a lot of ETFs, exchange traded funds, where it's a composite. So for example, if you've got a tracker investment, maybe that's on the FTSE 100. So that's a composite based on those. As one of those moves, you know that the value of the ETF will change as well. So if you can calculate that quicker than they can, again, you're seeing in advance what direction they're going to move in, and you can decide, do I want to buy or sell that, because you know what way they're going to move. So I think you're getting a feel there that do things quick enough. The challenge is everybody else is trying to do it quick enough as well. So you've got to beat them. Market making, I mentioned that briefly earlier. That's about providing liquidity. So you sit just outside the current spread and really siphoning off a few pennies on each deal. You're selling very large volumes, but only making a very tiny amount on each one. Some of the buying strategies. Smart order routing is what venue's got the best price. So looking around, there's actually a regulatory requirement on the banks there when they're buying or selling on behalf of a client that they've got to look around and find the best price for that. We have smart order routers to do that. Some of these other things, one of the impacts is that when you're buying or selling, it actually impacts the market. It changes things. So it's quite an interesting conundrum. So we end up with strategies like iceberg, where you don't want people to see, for example, that you want to buy a large amount of stuff, because as soon as people see that, then the price will go up. So you do strategies like slicing it up into lots of small orders, and then letting them out slowly, so that the market doesn't change so rapidly there. It's similar a sweep order. Crossfire. So there's also, as well as there being liquidity at the major venues, major organisations such as Barclays also have dark pools. And what that means is that that's liquidity we have within the bank because of our multiple clients. All the major banks have that. Now that's a dark pool, and what we can do is we can match orders against both our internal book, as it were, and external. And what's happened is most of the banks actually sell access to their dark pool. Barclays does it. It's called LX. There's other investment banks have similar dark pools. So as well as the big venues, London Stock Exchange, NYSE, NASDAQ, you have these other pools of liquidity out there where things are for sale, where it's a marketplace. And we're constantly having to look at those and decide, where do I want to buy, where do I want to sell? Are those prices the same? Are they different? How we assess the performance of some of those are using what's known as volume-weighted average price or time-up. So volume-weighted average price is really a way of looking at how well you did. Did I get a good price or a bad price when I sold that stock? And traders are actually assessed on how well they did by measuring them against that. So of course what happens is people write algos to try to make sure that they always get a good VWAP. Challenge there is though that you may have a requirement that you've got to buy or sell a certain amount, say during that trading day, and the market's only open for a certain period of time. You may find that you actually never get to a point where you meet your firing criteria on that, and then you're left with stock on your plate which you haven't been able to buy or sell. And that's where people would use a time WAP instead, which means that you're guaranteed to sell it within a time window. You're saying, well, I'm going to hang on to it for this period of time, get me the best price you can during that time as compared with the market movement. Risk analysis, whole host of stuff we do kind of before trade, during the trade and after the trade. A lot of that is looking at, okay, what's you've got value at risk in terms of as the market moves, what's that likely to do to my investments? You actually try to do this long-short balance to try to avoid if the market moves heavily in one direction or another, you don't want to be wiped out completely. So you can offset some of those risks by going long on other things you've got short and vice versa. So you're looking at that balance all the time there to try to mitigate those risks, so that you effectively putting limits on what's the maximum amount I'm liable to lose, what's the maximum amount I'm liable to make. You put limits on that rather than put the whole investment at risk. You've got a whole host of things going on during trade and after trade. It's become more and more regulated, as I'm sure you're all aware. Lots of people regulating it, ever bigger fines. In fact, there's even jail sentences you can actually get. So not only can you get fined, you can actually go to jail if you get it wrong. So very critical that it is monitored and controlled properly. Fat finger protection, that's the protection against the trader accidentally putting 3 zeros on the end of the order and ordering 1 million instead of 1,000. It happens we actually have to have systems in place. It's not just traders, it's people's code as well. That does it as well. That's what happened at the Knights Capital one. Is one of the algo engines went crazy, burnt through 500 million in 20 minutes. And again, we have to have systems in place to try to prevent that, try to control it. So there's a whole host of regulatory requirements, but obviously we have to control things ourselves as well. Trading protocols, so each venue specifies the format of messages, both for market data is really just the information about what's going on in that market. That's multicast out, anybody can subscribe to that after paying the venue a certain fee, that is, and you can see what's going on there. So that's sent out to everybody with one set of protocol, and then you've got another set of protocols which you're actually ordering, placing orders with. There's only a limited number of those, but the problem is that each venue changes the behavior slightly, and we end up having to have what's known as a separate feed handler for each venue. That requires a fair bit of maintenance and looking after those, because all the venues, they frequently change their behaviors. So you may find that you've got different venues which are both supporting, say, fix, but they behave slightly differently in terms of how they interpret and what particular fixed messages they want to mean something. That actually means there's a whole mass of business which goes on, or work which goes on in all the banks in terms of maintaining and keeping these feed handlers up to date. Often we talk about fix engines, so those are just systems which are just processing those and understand the particular protocol and how a particular venue is going to interpret that. Lots of products are available to implement that and to maintain those differences for you. So effectively, it's a buy or build decision on some of those. You can pay somebody else who will maintain those for you. These are all links, and when the slides go out, all the yellow ones are actually URLs. So I've tried to populate a lot of those so that you can follow up on some of those. Quick Fix is actually an open source implementation of Fix. It's very slow. Nobody would use it in the real world, but it's a good example of what one looks like. This is kind of a sell-side venue. So this is typically what you would see at London Stock Exchange or something like that. You've got connecting to it. You come through a firewall. The order will come into a fixed engine. Then it will go through a routing system and through to matching engines. The market would be split between, so they'd have some instruments on some matching engines and some on another, simply because of you can't get computers big enough to put everything on there, so they will split those. So that's what the order routing's doing, is sending those to the right matching engine. That's they're going to maintain the book. As orders come through, they get sent out to the market data systems so that all information is published and anybody can subscribe to that to see what's going on. As things happen, there's surveillance going on to make sure that the orders are coming through are within limits, that people can't place orders which are outside of their ranges. And then settlement is where eventually the information comes through, so that people can be paid for, or money transferred to whoever's buying and selling. So that's the sell side system. Buy side, so the kind of systems you'd have at an organisation like Barclays to actually then distribute that internally. So you've got the venues right over that side. Let's kind of start. So you've got trading floor people sitting on their screens. They're going to get market data through from the venues. So you've got market data distribution. Internally, typically, we would have a market data distribution bus for distributing that market data information, and we'd have a reliable message bus for actually having orders on. So the market data comes through, that's multicast data, but we have to make it reliable. And as you know, multicast data is unreliable, it's UDP. So we end up with having a lot of extra facilities there, such that if a system over here discovers it's got a gap, it's missing something, it can go back to the market data distribution and request that. Likewise, we keep things like the last value cache. So the market data coming through is just showing you what's happened at the moment. If I want to find out, okay, well, what was the last price of BP? You can go and query that from the last value cache. So that will keep those last values there for you. These are some of your trading engines actually running algos. You've got pricing engine, which is trying to make decisions on how you're going to price things you're selling. Analytics is doing some of the deeper research on that. This is where we have a lot of grids. So things get offloaded there. So we, particularly some of the complex pricing options. For a lot of those require pretty substantial computing to actually work out how you're going to price those things. What else have we got? Risk and compliance, smart order routing. We mentioned that. That's really when you're going to place your order. Okay, I now need to know which venues to send that to. So that's all calculated for you by the smart order router. The orders themselves are managed here in terms of making sure we've got a log of what orders are being placed, where they are. Those flow through into the trade booking system. So it's pretty complex. Again, a lot of systems. It's all going to be reliable. You're not allowed to drop any message. You can bet your bottom dollar that if you drop one packet coming in, you'll get the traders complaining that that's the one which cost them X million, because if they'd only got that one packet, they would have made that deal. We end up with massive root cause analysis activities going on just to find out why we didn't deliver that one packet out of the 5 million a second we were receiving. So this data coming in, it's time series data, and really what we've got now is a kind of a whole range of kind of specialized, what we call tick databases, to actually put those in. We ran out, normal SQL databases ran out of steam many years ago, the kind of insert rates we're looking at. So there was a number of proprietary systems came through. So KX with KDB is probably the most well known. Now there's been a lot of that being moving to NoSQL lately. Cassandra and Mongo are fairly popular. It's a matter of keeping up with these insert rates. As I say, we've already exceeded 5 million. We're told by them to design for 10. It's extremely bursty traffic, and trying to keep this kind of information. I mentioned briefly kind of quant programming. Really very much, it's really kind of more of a general term now in terms of the development of algorithmic trading systems. It used to be very much a particular subset of that, much more than the derivatives, but now it tends to be more general. It tends to be that if you haven't got a PhD, you won't even get through the CV screening. You know, that's kind of the reality there, that they kind of expect everybody to have a PhD in maths or something very similar to that. You would be expected to understand Black-Scholes, and that's really a well-known formula we use for option pricing. So a lot of mathematics there. You hear mentions of the Greeks, and really they're really just different ways. They're just partial derivatives, really, of the Black-Scholes there. So you'll see mention of those. You see standard algos which allow us to populate those. Even calculating things like VWAP and TWAP are quite complex to actually do. So you see a lot of maths in some of the QUANT programming there. So in terms of kind of programming language and stuff, dominated by C++. I would say probably about 70% of what I see going on in trading systems is probably C++ code. We have huge battles between the Java guys and the C++ guys, and really they do extreme Java programming, and they can get to similar kind of latency numbers as the C++ guys. But it is extreme Java programming, and I'll come on to that in a minute. So the teams are highly competitive. Java's probably kind of 25% of what goes on in the trading system, so a much smaller percentage. And then the other 5% are some of the other languages, particularly some of the functional languages and some of the other things. It all tends to be Linux-based, and you really need to have an understanding of how to tune that for low latency and low jitter. Out the box, it doesn't do it. It has to be tuned specifically for these environments. So there is an increasing amount of interest in functional, and I'll mention that later. So really around improving concurrency, that's kind of recognised. It's not so much in the algo engines, it tends to be further back in that trade cycle. We could talk about this race to the bottom. Really where we're starting to use some of these newer technologies, particularly FPGA and RDMA, and I'm going to explain what those are in a second. Plus, the other thing people are doing is moving towards deeper research and intelligence and doing that. So we've kind of got the two directions going on. Our people either go into extreme technologies to go very fast, very low latency, much more hardware assist, or they're looking at processing a lot more data, making use of some of the big data technologies there, and then using some of the technologies to help in that space. So some of that we talk about as intelligent trading, and this is an example from TIBCO, but it's actually a pretty reasonable one. You've got a real-time event server, you've got a real-time event bus, you've got data there that you may well have Hadoop and things. We have a lot of people now taking sentiment from Twitter, doing analysis of that coming through, and in fact, when there was it was several months ago, it got misquoted on the Twitter feeds that Obama was ill. Within seconds, the US stock price had dropped, simply because they were factoring in something's wrong with Obama, that's a risk. We drop US prices. So there's a lot of people now mining sentiment out of Twitter, seeing what adjustments they need to make there. So. Yeah, you have to pay. You have to pay to get. So they sell the fire hose. So yeah, if you want all the fire hose, then you pay money. Yeah.
You can even get convocation for Twitter now.
Yeah. So some of the low latency. So expect to have to do some packet processing. So TCP, UDP, multicast. We use distractor threads, so that's spin waiting for packets to arrive. You can save about 5 microseconds by doing that. The actor model, so yeah, minimize lock contention. We do a lot of timestamping. We use nanosecond timestamps. Microseconds not good enough. You won't see what's going on with microsecond timestamps. Direct buffer management, that helps. Warm everything up so you can allocate, preload everything before trading starts. For the Java guys, massive issues around how we control garbage collection. Jitter is the big problem we have with Java programs. So a lot of tricks and treats there which go on. amongst the Java guys to actually try to minimize that. When we measure the performance of systems, we end up very much looking at the tail, at the 99.9 right up to the 99.9999. It's those last few things where the jitter occurs, and again, it's jitter where you make money or lose money. So we have to avoid that. Pinning memory and cache line alignment, again, making sure you get increasing effects from the cache in standard CPUs now. Cache is fast, main memory in relative terms is slow. So you want to maximize your performance from the cache. CPU isolation, when you're running, you don't want anybody else to steal your processor and do things. So we go through a lot of tricks and techniques to make sure that my algo is running on this core and nobody else is going to run on it, and I'm going to stay running on that core, and my stuff is going to stay in that cache. That all makes a lot of difference. So how we control that and manage that, that's all required for this area. To get durability, typically now we replicate data across the network rather than write it to a file. It's much quicker to send data across the network. That way, once it's safe, then that other system can then write it to disk in the background. So that tends to be the common pattern now for getting durability. If you have got to write to disk, then typically we memory map the files. The whole low latency network programming is a whole area in its own right. So I'll mention some of the things there. We look at bypass technologies for TCP. You really got to move a lot of the TCP stack into user space. So there's techniques we do use for using that, onload and VMA there. TCP kernel bypass is where rather than using TCP, and TCP has big performance and latency issues for us. It is a big bottleneck, particularly once you get close to 10 gig. I'm running networks at 56 gig, so we're long past that. TCP is a huge bottleneck there, so we go to a lot of lengths to bypass it. We can use proprietary APIs, or we can use RDMA. Hello. Did I mention that? I think I scropped a page there, didn't I? Oh, yeah. So I'll come on to those on the Java expertise areas. So jitter avoidance there, expertise of NIO. So particularly with the buffers there. For RDMA on Java, we use something like Java fast sockets. A lot of tuning going on Java. Again, it's around garbage collection. C++. Expect to really be familiar with Boost. Some of the things like QUANT lib gives you the Greeks. Things like log3. Again, some of the memory optimization and tuning there. Okay, we finally get to what RDMA is. So it's remote direct memory access. So overcomes that TCP IP bottleneck. So I've measured in my area achieving 6 gigabytes a second. 2 microsecond, that's server to server. That's memory in one program to memory in another program. Application to application in 2 microseconds. It's a way we get very high speed transfer. So it's all hardware assist in terms of doing that. The challenge is, okay, well, how do I program it? And there's a number of different options there. I can just run TCP/IP, but then I only get a subset of the bandwidth. And really, we go through different APIs, different protocols until we get to the highest performance, highest throughput is what's known as the verbs. It's also the most complex to program with. RDMA and the verbs is really an asynchronous, reliable communication mechanism. So in terms of using that, we actually go through 4 phases. We actually go through a connection management and establishment. We create endpoints. We register memory. So it's transferring from memory in one system to another. That memory's got to be locked, so it doesn't page out. The hardware's got to actually know the translation. It's transferring from virtual memory on one machine to virtual memory on another machine. The hardware's actually got to know how to translate that. What a physical address is that memory block sitting in? So during memory registration, the hardware will actually load those translation lookup tables. We exchange memory keys, so that becomes secure. Then we actually do a data transfer. And what that is actually just queuing a work request. I want to read or write memory on that server, and that's just a work request. The actual transfer then takes place at wire speed by the hardware, so I can put in a single instruction, get me 2 gig of memory. When it's done, then I get a completion event to tell me that that's now happened. So this all happens with hardware error detection and correction. Make sure it's all happened reliably. So I've got far too many slides as usual. That's just talking, really showing that sending buffers from one system to another, as well as doing a pure RDMA. We can actually send data with the instructions. Let me skip through some of those. So the slides will be available. I mentioned very quickly something about CUDA and GPUs. So there's been quite a lot moving on to those, mainly around option pricing and some of those sophisticated things there. Let me just go back a slide there and concentrate on that one. That's probably going to be the better one. So you've got, it's really a sim machine where you've got single instruction, multiple data on these lightweight cores. And really the challenge is to transfer the program across to that in an efficient way and run that. Let me just kind of show that there. So we go through a phase there. We copy input data across to the GPU memory. We load the program across and we run that, and then we copy it back again. The challenge is trying to decide when is it worthwhile. I've come across many of the programs where the overhead of transferring it across is greater than the benefit you get from actually running there. So it's trying to decide when do we use it, when do we just stay and execute on the primary core there. Xcelent is a good example of a library which kind of allows us to program around that. That's actually quite a good one to actually look at. It's a data flow style library there. There's some code examples there. Really what's happening is it's unfolding some of these for loops and then allocating each of those on a separate core on the GPU. So the URLs on the slides we make available. Very quickly say something about FPGAs. They're fused programmable gate arrays. This is really about programming hardware, about creating hardware, and that's the FPGA allows us to do that. So we can write a program which actually reconfigures the hardware for us. The key thing is that for packet processing, I can start to process as that packet arrives. So I save 5 micros immediately. And I can actually do a simple algo and get my result out in under a microsecond. So the benefits on doing it are enormous. So we're seeing more and more of the high frequency trading, the simple algos, move to these kind of technologies. The programming is something like VHDL, and that's the Hello World equivalent. It's actually Blinker Light, but you can see that there's a link there. You can get the detail around it. So you compile, you assign, you configure it, and you start running the code there. It's actually a bit more complicated than that. We actually go through the design, the simulation, the synthesis. We test bed it. Pin assignment is deciding which pins you want to assign on the FPGA to particular functions. Great tutorial there is worth following. This is what debugging an FPGA program looks like. You are debugging hardware. If you're not comfortable with looking at hardware, you shouldn't be writing in VHDL, in my view. You really have to get down to that kind of level. So, but there are other ways into this kind of buy-build decision that you can buy stuff where it's already in. The main problem there is you're only as good as everybody else who's brought the same thing. So there's a tendency for us to try to build things ourselves, but you can buy in at various, at different points. We talk about a lot of IP, and these are pre-compiled components running on FPGAs. So people may have a TCP IP stack, a network driver, a PCIe driver, all those kind of things. And the richer they've got on those, then the less you have to write on your own code. What's interesting, I think it's a much better place for most people are using some of the high-level languages which have evolved around this. So BlueSpec came out of MIT, Xcelent really came out of Imperial College here in London, and IBM Labs have come up with liquid metal. I think they're much more better places for people from a software background to actually be programming. There are languages that try to convert from C and VHDL. Generally, they run C very slowly and require major modification to actually run. They only support a subset of the language. C the Verilog is actually an open source one by a couple of guys out in Israel. Impulse is a lot faster, but again, because of the architectural mismatch, you really need a data flow style of design to actually run efficiently on an FPGA. This is an example from Xcelent, and I think you can see that it's a much more understandable language. They provide high-level functions you can actually go use. Much easier for a programmer to use and keeps you away from those timing charts. In terms of parallel, I won't have to say a lot around that other than, yeah, we're having to go there. And that's mainly because when silicon hit about 40 nanometers, things stopped getting faster. Leakage currents were too high, capacitance was too high. And so ever since then, we've just got more cores. And unless there's a breakthrough in silicon technology which nobody knows about, that's what we're stuck with for the future moving forward. So I think we're all sold on functional languages here. So I think, let me just, in the interest of time, let me just skip through and finish on this one. So whilst this isn't strictly trading, there is a huge amount of dev work going on in all the banks around mobile now. So this is the other area where we see massive investment. Here at Barclays, we have a Ping It application. We're also doing a massive number of our own internal apps. All the banks want to get rid of buying BlackBerries for people and allow people to use their own stuff. So massive app development. So we have a massive growth going on in the banks, all around mobile applications. So a lot going on there. So a bit rushed. We're out of time. So any questions on that? We'll make the slides available, and you can follow through the links there. And in fact, I should have my contact details there as well.
Will you be available for the rest of the day?
Yes, yeah.
Okay, so he'll be around if you have any further questions. Okay, we can take a couple if you want to, one or two. Okay.
So, sorry. Actually, I have a lot of questions. So may I ask you some considerations on what I'm saying now? So you're a platform architect, you say. You have been in a few banks. What do you say as evolution of the IT in the front office? The quality of the IT skills of the people really buying and selling. And I'm surprised by the amount of C++ code because reference pointers and compilation techniques are not so skilled in removing boxing, so delays, basically, in the CPU. Talking about compilers, what do you see as research in compilers in banks and institutions? In some code we did in our public institutions, we did some coding on GPU based on Haskell. We did some FPGA starting from Lisp. But whenever we needed to shave off microseconds, we needed to go by hand. And that's not satisfactory. So what do you say about it?
Yes, so I mean, all those are true. You know, we see a lot of work going on. You know, on the Java side, I have people who are modifying the JVM all the time, and you know, it's jitter is the perennial problem on Java. So it's a lot of tricks to try to avoid that. I think, you know, there's a lot of very smart people in this field, and they're willing to try almost anything if they can get an advantage from it. So you know, there's a lot of opportunity there. So if you think that you've got a particular area which is fertile, other people haven't tried yet, then there's opportunity to pursue that. It's, you know, it's very much an environment where if you can show an advantage, then you get support for actually going and doing it.
Okay, I think we are late, so probably if you have other questions, you better ask him outside. Otherwise, we are open.